let's get to the big story breakdown. While inflation ended 2025 relatively tame, giving the Fed Reserve some breathing room as it balances stubborn price pressures against a cooling job market. Now, consumer prices rose 2.7% in the latest month from a year earlier, in line with expectations, and also suggesting the impact of tariffs remains limited for now. But for now, that eases pressure on Fed officials who cut rates last month and are signaling a pause ahead, even as high prices and a slowing labor market continue to weigh on American households. While we are halfway through the month, nearly, and geopolitics and politics are also dominating headlines. So joining me to separate signal from noise here at the New York Stock Exchange is Luke Lloyd, President and CEO of Lloyd Financial Group.
Hey, Remy.
Luke, great to have you here. Thank you so much for joining me.
Like you said, there's never a dull moment, right? So why not be at the heart of where money transfers in, the New York Stock Exchange, right?
Yeah,
I appreciate
absolutely.
You having me.
My pleasure. Well, we have to keep in mind that the S&P Dow seeing new record highs this year, but there's a lot of noise, a lot of headlines. So when it comes to the U.S. economy, where do you stand right now on growth, inflation, as well as liquidity?
Yeah, those are the three metrics we track every single morning. All of those still look really good. Growth looks good. Inflation's still coming down. We'll talk about PPI here in a second. But liquidity still is very strong with government spending and corporations spending on AI and all the money flowing in the economy. I think $8 trillion in money market accounts. The fact that private credit's doing very well. I think the big banks yesterday talked about how their investment banking sector and credit sector wasn't doing as good. I think private credit's actually taken some money out of the big banks, and a lot of these private corporations are making more money. So a lot of money's flowing throughout the economy, and that's a good thing. Now, when it comes to PPI, it's very interesting. You can't trust some of this data, though, because it's 45 days. The government shut down 43 days, roughly. A lot of this data is old, and the data wasn't collected for a 43-day period. So what can you trust? Now, there's a couple philosophies here. There's a possibility that PPI came in higher than CPI because possibly corporations are absorbing some of the costs. We'll figure that out here in the next few months as we get some more of that economic data. But at the end of the day, with AI coming throughout the economy, competition, AI inherently is disinflationary, and technology inherently is disinflationary. Deregulation is disinflationary. So even though the liquidity is strong, growth strong, that could be, but people would say that's inflationary, it's being offset by a lot of the other things. Also talking about credit card caps and all the other things, those are actually deflationary as well, because it's actually slowing economic growth if those things were to happen. So there's so many things going on. It's like you have almost a war going on of all these different data points of some things that are inflationary, some things that are disinflationary.
Yeah, and you bring up an important point because there's so many headlines coming through, and at the end of the day, we are keeping a close eye on price action here on Wall Street. So how are you separating the signal from all the noise out there?
Yes, that's a great question. So at the end of the day, macro data matters, and we track that again every single morning. And as long as those three metrics remain strong, we are right now higher beta in our portfolio. We are taking on more risk because everything suggests right now to take on more risk in the portfolio as that wealth separation happens that we talk about a lot. Where right now, if you look at corporate margins, they're the second highest they've ever been in history, 10.9% margins right now, which again, second highest. Large numbers. Corporations are making a lot of money. If you look at GDP, only 53% of GDP where salaries and wages, that's money in people's pocketbooks, only 53% of GDP comes from that. That's the lowest since 1949. So the point is there, corporations are making more money. The little guy at home, sadly, is still struggling. That's why even though you've seen the stock market at all-time highs, 401ks at all-time highs, the little guy at home still complaining about grocery prices, and they don't feel good, right? But that's wealth separation's happening. The only way for you to partake is owning stocks. So that's why we've gotten more risky in the portfolio with owning stocks like CoreWeave. That is a very high beta name, kind of high growth name that could go up 5%, down 5% in a day. But they're training AI models, and as liquidity remains strong, whether the business actually core business does well, those higher beta names, speculation, should rise with liquidity back on the table and that wealth separation happening and corporate margins remaining pretty high.
Yeah, and Luke, I'm sure there are viewers out there in the audience watching right now, and they might be looking at Wall Street at all-time highs, but saying prices are rising for them. And there are questions about the housing market as well as labor market as we head into this year. So first, because you mentioned private credit, what do you make of what's happening in terms of competition, and what are the takeaways from the big bank earnings?
So one of the core things for next year is coming from the big beautiful bill, the tax kind of situation. A lot of businesses are using their bonus depreciation, 100% bonus depreciation. There's a lot of things that are helping the small business owners. And if you're a small business owner or a large business owner, your wealth is tied to the success of the business.
Yep.
So a lot of the people that maybe aren't in business think that all these corporations with the tax cuts are going to put more money in their pocketbooks. That's not the case. That's not how it works. You want to grow the business. Maybe you're not paying yourself initially, but if your stock price goes up or your revenue goes up because you're hiring more people to grow it, your wealth is increasing. That's how business works. So my point is with that is I think a lot of these corporations are going to be investing in personal capital, personnel, software, and that's going to go into more pocketbooks. So when it comes to housing, what we'd like to see happen is housing stabilize. All these kind of inflationary pressures stabilize, but wages increase. And I think that's what's going to happen next year. You're going to see more wage growth than you've seen in a very long time, more money in people's pocketbooks. But again, does 4.5%, maybe 4% wage growth compared to 2.5% inflation really make a difference? 1.5% over inflation, you're not going to feel it greatly at home, but that growth is something we haven't seen in a long time. I think that's very bullish. Now, we do have to look international.
Yeah.
One of the core focuses for me is Latin America right now. A lot of things are going on in Venezuela, defense. I think they're breaking news this morning about Qatar, Trump announcing something over there. Defense is an area we're invested in. One of the stocks that's been our best performers this year, it's up 50% this year already, is AV. It's drone technology. And the government's already said they're pumping like $33 billion into drone technology new contracts. So that's an area we're focusing on, and specifically in Latin America with emerging markets, there's that mean reversion going on. As the capital markets in the United States is pretty expensive, there's other areas that need to catch up. So stocks like MELI, or one of our best performers last year, CIB, Grupo Sebesto, which is a bank in Bank of Colombia, kind of regrouped or did their name a few years ago. But I think that continues to be a strong suit as emerging markets continue to catch up. MELI is Amazon in Latin America. So there are other areas than just U.S. markets that you can make a lot of money on with liquidity remaining strong globally, not just here in the U.S.
Yeah, so you told us a little bit about opportunities and some names that you're watching south of the border. But when we look at U.S. markets, we can't deny the fact that the Dow, NASDAQ, S&P 500 had the third straight year of double-digit percentage gains. So what are opportunities you're watching here in the U.S.?
Great question. So last year, I think I was a little early. Last year, I was, we still did very well last year, don't get me wrong. But I thought it wasn't going to be as much Mag 7. It was going to be more bottom 493 and more equal weight S&P. It was more Mag 7 the first half of last year. The equal weight and other stuff caught up towards the second half. I think this year is truly going to be the second, third derivatives of AI. It's not going to be the Microsofts, Apples, Amazons. We own Google and Microsoft. Those are the only two stocks we own in the Mag 7. We don't touch anything else. Google was one of our other good performers last year with their AI demand and chip making. But the second, third derivatives like Accenture, ACN, other kind of areas like I mentioned, CoreWeave could be a stock. We're taking a look at all these different areas within AI. I think those are where you need to focus on the second, third derivatives, not the Nvidias, Palantirs of the world. I think all that money needs to flow out. That's why the equal weight's up 3% this year, and the S&P is up I think 1.5% already. So you're already seeing the outperformance and that breadth widen. And I think that's going to continue to happen.
Well, Luke, a lot of moving parts here, so thank you so much for breaking it all down for us. I appreciate your time, and thank you so much for all your insights.
Always fun being here.
Thank you so much.